Right, hey, welcome back to Principles of Accounting 2. I apologize for so much time in between. The last time I've seen you, it feels like it's been close to a month, which I think it's been close to a month. We had a lot going on in the month of October. We had I think it was like three LinkedIn Learning certificates. We had the midterm exam. We had I was at a conference last week. Um, just craziness, just super crazy. So I apologize that that much time went by without being with you in person, so to speak. So, but I'm glad to be back with you, all of you, and hopefully you're happy to be back in class. I know that this class isn't always the easiest, but it is a little bit more straightforward than Principles of Accounting 1, and I'm sure you would agree with that. But I just want to say thanks. I appreciate all of your hard work in the class and everything that y'all have been doing throughout the past couple of weeks, especially. So I appreciate all of you. I really do. So okay, we're in the class right now. I just wanted to kind of just do a little bit of recap with you. So shockingly, we are all the way down in week 11, and we're almost done, believe it or not. We only have a couple of weeks left. It goes by pretty quick overall, so I just kind of want to just to kind of remind you where you are, or where we are, and where we're heading. Today we're going to talk about flexible budgets and standard costs. We're going to talk about this thing called variances, which is the difference between a standard cost and the actual cost. And it's a topic that's very complicated, so I'm going to do my best to talk about all the different formulas that are involved here, so that way you have a really good understanding of this topic. And then next week we'll roll into performance measurement and responsibility. I believe that we have a holiday this coming Tuesday, which is Veterans Day, so we'll have class on next Thursday and talk about performance management responsibility then. And then after that, we'll roll into relevant cost decision making, capital budgeting, and then we'll wrap up the semester. So that's where we are. So it goes by quickly. So let's keep up the positive momentum and keep the ball rolling. So without further ado, I'd like to bring us to our conversation today, which is on flexible budgeting and standard costs. And we're going to talk about how we set standard costs, what they are. We're going to talk about the difference between the actual cost and the standard cost, also known as the budgeted cost. We'll talk about how these costs relate to the flexible budget. Um, and I'm going to go through a lot of different computations with you today. So this chapter, I will say, this discussion today is very difficult for most students. This is probably the most challenging um, concept for most students to learn and understand is how we calculate this thing called variances, which is the difference between the actual and budgeted or actual and um, standard amounts. And so, as we talk about these today, I want you to pay very close attention to the formulas. Once you understand the basic formulas, the rest of it becomes easy. There's a lot of different types of variances that you'll learn how to compute today. So I want you to really get a great grasp of the basic formulas, the first couple of formulas we're going to talk about, because the rest of them are very similar in nature. They're simple once you get the hang of it, but I wanted to make sure that you're aware that this is a very difficult topic overall for most students, including myself. In fact, I personally failed several questions on a certification exam related to cost variances. And so that's the other reason why I wanted to make sure that you understood this topic as well as you could, because this topic really is very challenging. So let's go ahead and jump into it. Uh, I'm going to talk to you about what standard costs are, how we prepare them, why we set them. We'll talk about the flexible budget, and how we compare that to our performance or actual results. Uh, and we're going to calculate a whole bunch of variances. And the word variance just means the difference between. So it's the difference between the actual amount and the budgeted amount. So briefly, we'll talk about the budgets. I believe last week we talked about the master budgeting process. Well, actually, it was in the recording for you, but we talked about the master budgeting process, and I think we briefly touched on the difference between a fixed budget and a flexible budget. So just to kind of recap those, as you know, a budget is how we give direction to the company. This is our guiding light when it comes to how much we should be spending and on what things we should be spending them on. That's what a budget is, and that's what a budget does for us. We start every single budget with a sales budget. The sales budget helps us to derive the production budget. The production budget tells us how many units we need to make based off of the sales budget. Within the production budget, we have the direct materials budget, the direct labor budget, and the variable and fixed factory overhead budgets. We combine all of those things, right? And it leads us through all the way down to the cash budget. And we also have the capital expenditures budget and our selling general administrative budget, which helps us to prepare the income statement budget and the balance sheet budget, etc. Right? So, um, all of that, all of those individual budgets are a part of the master budgeting process that was covered last week. And once you've prepared the budgets, we then need to find a way to best compare the actual results to the budgeted performance, or actual performance to the budgeted components. And we do that through what we call budget reports. Uh, there are really two different types of budgets that we have. One is a fixed budget. The other one is called a flexible budget. A fixed budget, as the name implies, is it's a static budget. It's fixed. It does not change with the level of output. It does not provide any uh, ability to be close to the actual performance. Okay. So for if we're over or under certain but for certain line items, we're favorable or unfavorable on certain line items. With if we're comparing a fixed budget to the actual performance, that those variances could be really big. And so that's why it's always best that we try to stick to a flexible budget whenever possible. This allows for us to benchmark the actual results to a more closely aligned level of activity. Okay. So here at the bottom of this slide, we can see the difference between the fixed and flexible budgets. Now, let's say we planned on selling 100 units. And so if we sold 100 units for the fixed budget, that's great. For the flexible budget, that's also great. But what happens if we sold 120 units? Well, that makes the fixed budget not as useful because it creates all these really big variances. And so having big variances, that's not very helpful for us as managers because we want to be able to understand why these differences or variances are occurring in the first place. And if I'm comparing my actual performance to a fixed amount, that's not very helpful for me, right? So I prefer flexible budgets, and I think most companies do as well for that reason. It allows for us to produce more or less and be close to the actual results. That level of closeness helps us as managers to be better when it comes to analyzing the reason why the differences or variances have occurred in the first place. So, uh, based off of a fixed budget, it doesn't allow for a whole lot of variance. So, because it's fixed, it means it does not change with the level of output. And so we base off of what actually happens, we compare it to our budgeted amounts, and we see that with a fixed budget, it creates very large variances. So, as I said, a variance is the difference between what we budgeted and what actually happened. And so here we have in this example, we we planned on selling 100 units. We actually sold 140 units. Well, that part's good, right? We sold more than what we had budgeted for. So that's good, right? In terms of units and sales dollars, that's a good thing because we sold more than what we had budgeted for. So instead of selling $80,000 worth of stuff, I sold $105,000 worth. That's a good thing. That's favorable, right? It means I sold 25,000 more than what I had planned on selling. Great. But as you know, when we sell more, we incur more expense, right? Because the higher the level of activity, the higher our variable expenses are. So the variable expenses, that's not so good because they're higher than what we had budgeted for. So here we see variable expenses or variable costs, 54,600. We only plan on 36,000. So that's unfavorable when your expenses are greater than what we budgeted for. Contribution margin, that's a good thing. Contribution margin is higher than what's expected, favorable. Our other fixed costs, slight difference, $400 here. Something must have changed. Maybe like we paid an employee a little bit more than we should have, or we used more uh, something. Maybe the rent changed, maybe our insurance went up, whatever. And so that's unfavorable, $400, because anytime your expenses are greater than the budgeted amount, that's unfavorable. But when your income is higher than the expected amount, that's favorable. You know what I'm saying? So, so it's important to understand when it's favorable, when it's not. So, based off of the comparison between the fixed budget and the actual results, it tends to lead to higher variances, higher differences, and that makes it more difficult for managers to pinpoint any type of issues. So that's why I don't really like fixed budgets. I prefer flexible ones. So with a flexible budget, it really does allow for more variance to occur, but we can compare the actual performance a little bit closer to the budgeted amounts, and that gives management a little bit more insight into why these differences are occurring. All right. So it provides that more what we call apples to apples type of comparison, is what I'm saying. And it also allows for different levels of activity. So I like to call it the low, medium, high range, or the different levels of activity. So low level of activity, medium level of activity, high level of activity. It allows me to be able to be flexible when it comes to comparing the actual to the budgeted performance. So here we have that what that flexible budget looks like, and we prepare these in a couple of different steps. The first step is we identify the different levels of activity. Okay, and it's based off of the number of units we expect to produce and sell. So in this example, 10,000 units, 12,000 units, or 14,000 units are my different levels of activity. Low, medium, high is another way to think about this. So the first thing we do is identify the levels of activity. The second thing we need to do is identify the costs and classify them as either being fixed or variable costs. So we're separating out our variable from fixed costs, just like we've done before. So we know that variable costs are direct materials, direct labor, uh, and variable costs also include the variable part of overhead. Okay, variable part of manufacturing overhead. The fixed components are costs that do not change with the level of output. Those include things like the fixed part of manufacturing overhead and other fixed expenses. So we separate those things out. Okay. Uh, so that's step two. Step three is we compute the sales budget, variable cost budget, fixed cost budget, and the budgeted income. And we do that typically through our master budgeting process that we talked about last week. Uh, and all of that leads us to um, our total budgeted costs. There's a formula that we can use to find total budgeted costs, and that formula is the total fixed cost plus the total variable cost times number of units, or also known as total fixed plus total variable costs. Uh, Great question, Caleb. The question is labor always a part of the flexible budget? It's a great question. So it depends. But the answer is yes. Uh, it's always going to be a component of variable cost for direct labor. Will always be a part of variable cost. So therefore, yeah, it'll be in the flexible budget. It could also be in the fixed part of the budget, if it's something like a supervisor's salary, or indirect labor. So great question. The answer is yes. It is. It's also always a part of the fixed budget as well. So great question. Yeah, exactly. Yep. So the primary differences between variable and fixed is that with variable costs, it includes the cost of manufacturing, which are direct materials, direct labor, and variable factory overhead. Those equal the cost of making a product, and so therefore we're going to see the direct material as a part of variable costs. You'll also see on the fixed side the supervisor's salary and other indirect type of labor. So great question. So that's how we find the total budgeted cost is we take the total fixed amount plus the total variable amount. And the way we find the total variable cost is we take the variable cost per unit, multiply that by the number of units produced. So very, very straightforward. Now, once we get our actual results, we want to select, with the flexible budget, we want to select the level of activity that is closest to the actual results. Because we want to be able to identify any variances that have occurred that we as managers can easily address. We can see where variances have occurred based off of the activity level. So here we have in our example, we expected to produce and sell 12,000 units. That was part of the budget. And the great thing is, yeah, we ended up producing and selling 12,000 units. So excellent. So we're right on the money when it comes to the budget and in terms of level of activity. Now, of course, sometimes it'll be just a little bit less, just a little bit more, whatever. But there's a couple of variances I want to call your attention to that kind of stick out in my mind. The first one is the sales variance. We planned on producing and selling 12,000 units, but we only planned on selling them at 120,000. We actually sold them at 125,000. So what happened there? Well, what probably happened is that we increased the sale price at some point, right? So that caused a $5,000 favorable variance. Then when we look at our costs, we take the actual amount minus the budgeted amount to get our variance. And in this case, there's $1,000 variance for materials, $2,000 variance for labor. So I wonder what happened there. So what this tells me is that I spent more on materials than I had planned. Now, what that might imply is that maybe I changed vendors, maybe the cost of the materials went up for whatever reason, maybe inflation, whatever, tariff, whatever. Or maybe the quality of the materials that I'm using is higher. So it, in turn, costs more. So whatever it is, as a manager, I like to find out. Or maybe I've wasted some material in the manufacturing process and that caused the price to be higher. Possible. So I look at things like a price variance, a quantity variance, and an efficiency variance. We'll talk more about those soon. When it comes to the direct labor, I spent $2,000 more than what I had planned on. So what happened there? Great question. I don't know. Maybe I paid my employees more because they were higher skilled. Maybe they were more efficient at their jobs, so I paid them more. Yeah, possibility. More skilled labor typically means a higher wage. Maybe our employees took longer on the job than we had planned on. That would result in a higher direct labor variance. So, a couple possibilities here. So I'd be very concerned about those two, and I'd want to take a closer look. The other variances I'm not too worried about because they're very small in nature. The indirect materials, sales commissions, not very big differences there. Insurance, not a big difference there. But I would want to look at the direct materials and direct labor variances as a manager because I want to see what's going on, what's causing those differences to occur. And so that's what we're going to do here soon. So before we can understand the variances, we need to understand what our standard costs are. And so I'm going to explain that to you now. When it comes to a standard cost, the way I like to think about what a standard cost is what I normally pay. So think about in a normal condition, normal setting, what I would normally pay for something. That's my standard. That's what it normally costs. That's my standard. Okay. For example, I normally pay $22 per hour to my employees. That's the standard rate. Okay? I normally pay $10 per pound of wood to make my baseball bats. That's what I normally pay. Uh, it normally takes a pound and a half of wood per bat. That's the standard quantity. It normally takes 1/10 of an hour to create a baseball bat. That's how long it normally takes my employees to make it. So these are my standards, right? So the way to think about standards costs are that it's what we normally pay. It's our budgeted amount. Okay. And we do this for direct materials, direct labor, and variable factory overhead. So let's take a look at each of these areas so we can have a better understanding of what's going on. So for direct materials, we set a standard price for the materials that we're purchasing and a standard quantity and quality of those direct materials. So I normally purchase each pound of wood for 10 bucks, and I usually use about 2.5 pounds or 2.2 pounds of wood per baseball bat. Okay, that's my standard. For direct labor, we are looking at how much we normally pay our employees, our standard rate, and we're also looking at the standard number of hours it takes to produce a single unit. So, for example, it normally takes 2 hours to produce one baseball bat at a rate of $15 per hour. Okay, that's my standard. And we look at those, we measure those standards through motion studies and time studies. These studies we use stopwatches basically to see how long it takes for the employees to do things, and motion studies how many movements, how many physical movements are involved. And so that helps us to get an exact time for our employees' rates. And then the other thing I look at is my overhead for variable costs. I have a standard rate for variable costs. Let's say it's $10 per direct labor hour. That's my standard rate, my factory-wide rate. And that's based off of the number of direct labor hours used. So those are how I set my standards. So let's look at this in an example. Our company produces baseball bats. We use these standards to produce one single bat. So we use 2.2 pounds of wood. At $10 per pound is what we normally pay for our wood. So that would cost me $22 per baseball bat for wood. Uh, It takes my employees an average of 2 hours to produce one baseball bat, and I pay my employees $15 per hour. So that gives us a standard rate of $30 per unit per baseball bat. And then for overhead, my standard is 2 direct labor hours at $5 per hour. Per baseball bat, that's 10 bucks. So I add up all my standard costs, and it usually takes me about $62 to produce one baseball bat. So those are my standard costs. Once you have your standard costs set for your products that you're making, then we can look at computing the variances because we're going to compare each of these standards to what actually happened, to what actually happened. Okay, so let's look at the types of variances that we calculate. We really look at the difference in all of our costs. So the difference in number of hours that it takes, the difference in the hourly rates, um, to really understand our variances, our differences. So we call these differences cost variances. It's the difference between the actual cost and the standard cost. And these could be either favorable or unfavorable. A favorable variance means that the actual cost is less than the standard cost. That's favorable. When the actual cost is greater than the standard cost, it's unfavorable. So pretty self-explanatory, but I just want to make sure you understood it. So for us to be able to calculate our variances, we need to understand the physical flow, right? Just like we do with anything else, we look at the physical flow. So we go through this process. The first step is to prepare the standard cost performance report. So we compute our standard costs, first thing we do. Second thing is we compute our variances and we analyze them. The third step is we ask questions as to why these variances have occurred and what we could do to mitigate these variances from happening again in the future. And that leads us to step 4 is to take that corrective action to make sure that these don't happen again in the future or to minimize those variances. So that's the 4-step process. So let's go through and compute these variances, and I'm going to try to explain this in the easiest way that I can because these computations can get very complex. Okay. So what you see in front of you, this is our most standard cost variance in its simplest form. Okay. And it's pretty easy at first glance, but I want you to understand the variances, which is the difference between the two. So the first thing we do in this process is we compute our actual cost. And that's pretty easy to do. We take the actual quantity, which is the actual quantity of the materials or labor that we've used, times the actual price or the actual rates that were paid. So actual quantity times the actual price. That gives us our actual cost. Makes perfect sense, right? Then we need to compute our standard cost. And the standard cost is very self-explanatory as well. We take the standard quantity, the amount of materials or labor that we actually or that we typically use, that we budgeted for, and we multiply that by the standard price or the standard rate that we would normally would pay. Yep. Now, once you have your actual cost and your standard cost, all we're doing here is we're subtracting actual minus the standard to give us our cost variance. Now, at a glance, it seems pretty simple, but there's a lot of variances that you need to understand that are with between the actual and the standard cost. And so the first thing that we would do here is compute that cost variance. And the way that we would do that is we would take the or what's in between. And the way we would do that is we would take the actual price and multiply that by the standard quantity. Actual price times the standard quantity is going to give us what the variance implied should be, right? Actual price times the standard quantity is going to be the variance, what it should be. So I'm going to show you what this looks like here. So what we're going to do first is I'm going to show you how we compute the direct materials variance and the labor rate variance. So first, the direct materials and direct labor variances. These are what we're looking for here is we're looking for differences in price or rate and difference in quantity or efficiency. So first, let's calculate the price variance. And the way that we do that is we take our actual cost, which is the actual quantity times the actual price, and we subtract that from our middle variance, so our expected variance, which is the actual quantity times the standard price. Okay, so actual quantity times the actual price minus the actual quantity times the standard price gives us the price variance. Okay, so the way I explained it earlier is you want to think about what's middle between the two. Yeah. To calculate the quantity variance, we're taking the actual quantity times the standard price minus the standard quantity times the standard price. That gives us the quantity variance. Okay. We can rewrite these equations a little bit more simply. Okay. For the price variance, we could take the actual price minus the standard price, which is the price difference, and multiply that by the actual quantity. That's another way to rewrite the price variance formula. And in my opinion, it makes it a little bit easier as well. So actual price minus standard price, and then we multiply that by the actual quantity. That's the price variance formula. The quantity variance formula, very similar. We take the actual quantity minus the standard quantity, and then we multiply that amount by the standard price. So I want you to pay very particular uh, attention to those basic formulas because you'll find that they're similar in nature to the other variances that we're going to calculate. So let's apply our baseball bat example to these variances. So let's calculate the direct materials variance. The direct materials variance uh, typically includes a price variance and a quantity variance. So we're going to take our data and apply that accordingly. So the first thing that we'd want to do is calculate the actual cost. Just pretty simple to do. We take the actual quantity times the actual price. Now we actually purchased 1,800 pounds of wood at a cost of $21 per pound. That gave us an actual cost of 37,800. We then calculate our standard cost. Our standard cost is 1,750 pounds that we normally would use or normally would purchase. And we multiply that by the standard price of $20 per pound, which would give us a standard cost of $35,000. Then we go and compute the internal variance, which is the actual quantity times the standard price, which gives us uh, a variance of 36,000. Now, once I have that first variance of 36,000, I just take my actual minus the variance, which gives me the price variance in this case, which is $1,800 unfavorable variance. I can then calculate my quantity variance, which is once again the variance minus the standard. In this case, it's $1,000 unfavorable variance. I can add those two together, those two variances together, price plus quantity variance, gives us my total direct materials variance, in this case, $2,800 unfavorable. So that is how I would compute my direct materials variances. Once again, it's a matter of taking those basic formulas that we've already talked about and then just plugging in the data provided. Uh, Management then should be investigating why these material variances have occurred in the first place. And so the management will speak to the purchasing department to investigate, hey, what happened? What caused the changes in price? What caused the changes in quantity? And so they'll have a reason for it, and then we mitigate that so it doesn't happen again in the future. Yep. So that's direct materials variances. Next, I'd like to talk about the direct labor variances. These variances typically occur because maybe the skills of our employees are different. They have different hourly rates. Maybe there was a change in those rates. Maybe there was a change in how efficient they work. So that's why we calculate these variances. So using the same data from our earlier example, we can calculate the rate variance and efficiency variances. So just as we've done before, we go through the same steps. First, we can compute the actual cost. The actual hours used was 1,700 hours at a rate of $33 per hour. That gives us an actual cost of 56,100. Then we compute our standard cost, which is 1,750 hours that we've gotten from the prior step, times $32 per hour, giving us a standard cost of 56,000. So I can already see the difference here, right? 100 bucks. I then compute my middle variance, which is the actual hours times the standard rate, giving me 54,400. I can then compute the rate variance by taking the actual minus the variance, giving me a rate variance of 1,700. I can then compute my efficiency variance by taking the variance minus the standard, giving me a favorable variance of 1,600. And then I just very simply, once again, subtract the two, and I get my difference of 100 bucks. So that's a $100 unfavorable variance. So not a huge variance, but it's something. But it's important to understand what's going on between these. So if I were in management, I would just be like, hey, something's going on with this rate variance. I'd really want to understand why that's occurring. And so management will investigate and they'll say, hey, this 1700 unfavorable, why is it so big? What's going on with this rate variance? And they'll say, oh, well, we actually paid our employees $1 more per hour because they're really high skilled and therefore they deserve to be paid a little bit more. Okay, that's fine. But we in management need to understand that because we need to be able to control our variances as much as possible. Yep. So now that we've computed our direct materials variances and direct labor variances, it now comes time that we calculate our overhead variances, controllable costs, and volume variances, respectively. And the way that I begin to do that is I need to look at my overall variances, and I do that based off of the level of capacity that we have. So based off of the number of units produced, I then find the closest flexible budget based off of capacity or number of units produced, and I compare that to the actual amounts. And so what that does is it gives me the closest variances possible. Uh, from this, I can also look at the variable amount per unit to get total variable overhead on a per unit basis, and also the total fixed amounts. Now, once I've done that, I can then go through the process of calculating the standard overhead rates. So, first step is we determine the allocation base. Is it machine hours? Is it direct labor hours? Whatever. The second step is we predict the level of activity based off of percentage of production, based off of capacity, or number of units being produced. And then step three is we compute the standard overhead rate. And the standard overhead rate computation is we take the budgeted overhead at the predicted activity level divided by the standard allocation base at that same predicted activity level. Okay. So once I have that, I separate out my fixed from variable, and I plug those into my to my formulas. So the overhead variance, of course, is the difference between the actual overhead and the standard applied overhead. The standard applied overhead we calculate by taking the actual production times the standard amount of allocation base, and we multiply that by the standard overhead rate. To find the overhead variance, we take the total actual overhead minus the standard applied overhead. So management has determined that our standard overhead rate is $10 per direct labor hour, using the same information we have from from our earlier example. To find the standard applied overhead, we take the actual production, which in this case was 3,500 units, times the standard amount of the allocation base, which is half an hour or zero point 0.5 per unit. And then we multiply that by the standard overhead rate we got here of $10 per hour. Our standard applied overhead in that formula is 17,500. So we take the actual total overhead, which was 18,150 that was given to us, minus the 17,500, giving us an unfavorable overhead variance of $650. Okay. Uh, let's take a closer look at that variance here through the volume variance. A volume variance is the difference in the level of production. So number of units that have been produced in comparison to the budgeted amount. This leads us to what we call a volume variance. So just as before, to find the actual, we take the actual price times the actual quantity. For the standard, it's the standard price times the standard quantity. To find the variance, the actual times what's the actual rate times the standard quantity gives us the that budget that flexible amount. And to compute the controllable variance, we take the actual minus the budgeted amount, gives us $850 controllable variance. To find the volume variance, we take that budgeted amount minus the standard, giving us $1,500 unfavorable volume variance. I subtract those variances, and I get $650 unfavorable total overhead variance. So relatively straightforward. Again, we're taking those very basic formulas that we learned earlier and applying them. Same with a controllable variance, very simple to compute. We take the total actual overhead, actual rate times actual quantity, standard overhead, standard rate times standard quantity, the difference or and the flexible budget, actual times the standard. Now we compute the differences. Uh, and that's how we find controllable variance and volume variance. So just like before. So the actual minus the budgeted amount, giving us the difference, in this case, $850 favorable. And once we found all our different variances for overhead, we can compute, or I'm sorry, not compute. We can create the overhead variance report, which specifies the comparison between our controllable expenses and our volume variances, comparing the flexible budget to the actual results, and it helps us to align all the different variances. Right? So pretty straightforward overall. It's important that we understand the differences because as a manager, you're going to need to be able to do kind of a deep dive in these types of variances to really understand what's causing those differences to occur. This next slide here, this really gives us a really beautiful kind of summary for direct materials, direct labor, and overhead variances and their respective calculations. So Once again, really understanding those basic formulas that we started with in this conversation, those are really, really going to help you to really understand how we compute each variance. We can also compute other variances like the sales variance. As a manager, you might be responsible for sales, and so you need to be able to compute sales variances um, because they really do help us to do kind of a deep dive into our products. You know, what's selling, what's not selling, those types of things. So here we have a sales variance. This company is creating uh, golf balls and as well as the golf clubs. And so here we have the budgeted amount and the actual performance. We can see that we sold 100 more golf balls than we had planned on at a higher price point, 50 cents higher than what we had planned on. We sold less uh, golf clubs, about 10 less than we had planned, and we sold it at $10 less than we had planned as well. So, based off of those variances, we can compute the sales price variance and sales volume variances for each unit that each different type of unit that we sell. And as a manager, again, computing these types of variances is really important because you might need to do a deep dive on specific products or line items that you sell in order to determine if you have the right sale price, if you have the right quantity that you planned on selling, those types of things. And to really help you to hone in on those differences to be able to explain to upper management, what's going on here. But again, they're the same basic formula that we've been using, the actual compared to the budgeted amount. Uh, we can see these variances in a nice flow chart. Looks like this here. Um, total overhead variances can be separated out into variable and fixed components. And then we can further analyze those variable and fixed components with other variances. So spending variance, efficiency variances, volume variances, and controllable variances overall. And we can calculate those out by taking the actual results minus the budgeted amounts to get our respective variances for both variable and fixed overhead. This is what we see here. And we can compute our spending variance and efficiency variances using the same exact formulas that we've explained earlier on. So your actual rate times your actual, the standard rate times the standard, and then of course the difference taking the actual times the standard. And then we simply subtract those out and we get our total variable overhead variance and fixed overhead variances, respectively. Breaking it out even just a little bit further, uh, here we can see our variable overhead variance by taking the actual minus the standard, which gives us our variable overhead variance. And we do the same thing for our fixed variance, actual minus the standard. So it becomes pretty easy once you apply those basic formulas that we learned earlier on. So that's why it's important that you get before you jump into the all the different variances. And there's a couple of journal entries that we need to make with respect to variances. Um, And we make those journal entries with respect to work in process. So we debit work in process inventory. We debit unfavorable variances for both price and quantity with respect to materials. And then we credit the total raw materials inventory. We do the same type of journal entry for direct labor. So if there's a efficiency variance and a rate variance, we debit and credit those variances respectively and apply those costs, those variances to work in process. Uh, and uh, we apply, lastly, our volume and controllable variances from overhead, and we apply those to work in process. So, that actually leads us to the end of our conversation today on variances. This concept, once again, is very, very difficult for a lot of students to understand. So, I want to just draw your attention back to, I'm just trying to find the right slide. I'm sorry, set of slides. Here we go. Going back to these basic computations. Um, are really going to help you to better understand these. So understanding how to compute the actual cost, actual quantity times the actual price, and the standard cost, standard quantity times the standard price, and then just simply subtracting the two, actual minus the standard, is what's going to give you the most basic cost variance. Now, once you have that, then applying that same concept to find your other variances is going to be key. So finding that middle piece is also very important, actual quantity times the standard price. That helps you to compute your variances more accordingly. But the bottom part of this slide is what I want you to really focus on because these two formulas are simplified versions of the ones above, and these are the ones that will help you along in calculating all of the other variances that we talked about tonight. So I'd like to end here. Are there any comments, questions, concerns about anything that we discussed tonight or anything about the class in general, about the university in general, any questions at all that you feel that I can help to answer? Now's your time. This is your time to ask anything and everything. Any comments, questions, or concerns about anything that you have? This is your time to shine. Your question, your Q&A, whatever it takes, anything at all. Are you 100% satisfied? So, oh, really? I'm so surprised. Okay, well, let's take a look just quickly again in the classroom. What we have due by Sunday night and where we're heading from here, forward looking. So we're in week 11. Believe it or not, I know it's shocking, right? So it goes by really quickly. The only thing you have due to me by Sunday night is the chapter 23 assignment, and then that's really it. If you have any past due work, just make sure you get caught up. That's really important, obviously. Um, And then next week, we're going to meet on Thursday because I understand that this coming Tuesday is Veterans Day. So we will meet next Thursday, which is November the 13th. Um, actually, and then we'll meet the following Thursday as well, because I think I kind of did an oversight there. I thought actually forgot about that we're closed on Veterans Day. And then at the following week, we'll do relevant costs for decision making, and then after that, capital budgeting, and then we're going to wrap it out, which is awesome. So we only have a few weeks left. So If you have any comments, questions, or concerns about anything at all, you can always email me, you can call me, or set up office hours, whatever you need. I'm here for you, okay? So, uh, again, thank you all so much for your hard work in the class. I really do appreciate everything that you're doing so far. Um, and I wish you all the best success, a great weekend ahead. Um, and again, if you need anything, feel free to reach out. I'm here for you, okay? So thank you all so much for your time tonight. I appreciate all of you.
All right, thank you, Professor.
Thank you. It's my honor,
Thanks.
Caleb. Yep.
All right.
Thank you.
Thank you all so
Thank
much.
you.
Have a great night.
Okay, like real quick. So you gonna go over the final with us? Or
Of course I will. Come
okay,
on now. I'm not going to
all
leave
right,
you hanging.
okay, all right, all right.
All right, for sure.
I appreciate it.
You're very welcome, my friend. I'll catch you later.
All right, bye.
All right, take care. Good night. Good night. Good night. Take care, y'all. Ciao for now. I will catch you later. See you next Thursday. Bye bye.